My main concern when I see deals like this, they dump stock into the market after a 4-month hold.
The best way to avoid fast money coming into this company is for the shareholders who are currently owning the company to take up their rights.
Some of them, may not be able to. Also be long suffering, buying in at much higher prices, and you're asking them to kind of double down on something which you need to give them comfort that you believe you're going to be able to get over the line. Hello and welcome to Crux Investor. First of all, thanks so much for watching this video. If you like it, give us a thumbs up, it'd be much appreciated. And of course, do leave your comments below. It helps us understand the sorts of questions you think you'd like us to ask, how you think we're doing, and of course, what you think of the company. And for early access members on Crux Club, which you get at crux-club.com, you'll be able to see this video and hear the podcast first. After which, you'll be able to get the video, podcast, articles, and transcripts on cruxinvestor.com. And if you haven't already done so, please click the button in the corner of the screen to subscribe to our YouTube channel. And of course, for more videos like this, click the notification bell. We spoke earlier today to Wayne Heili, CEO of Peninsula Energy, ASX listed junior with the uranium assets in the US. They've just announced they're going to raise $40 million. We ask him why. The main component is to take out some existing debt. We kind of go through the numbers. We look at how the market's reacting. Aussie retail, none too happy. But hopefully, once they read the prospectus and hear what Wayne has to say, they might understand a little bit more about the process that they've gone through. We also talk about what they're going to be able to do with any residual cash that's left over. And of course, they are still generating sales through their long-term contracts. So lots discussed. We get into some gruesome details. I apologize for that. Take a look at the description below. Any topics interest you in particular, click on the number beside that topic, and that's called a timestamp. That leaps you to that part of the video. Enjoy what Wayne has to say. Hey Wayne, how you doing, sir?
Fantastic, Matt. Nice to talk with you today.
Yeah, appreciate it. Thanks for coming on at such short notice. Do appreciate that. You've got some big news, which I want to discuss with you. But first, let's give everyone new to the story that 1-minute overview of what your business is about.
Right. Well, Peninsula Energy over the past 2.5 years has been making significant advances in transitioning our existing alkaline-based in situ recovery operations in Wyoming to one that's going to use low pH mining solutions. We think that'll significantly enhance the economic potential of that flagship property for us when we recommence production. But our numerous achievements over the last several years, Matt, have that combined with the improving outlook and for uranium demand in the market have not been reflected in our share price. Our board, our folks believe that the specter of near-term maturity of the debt that our company carries has been the burden. It's been the reason why our share prices and our share performance hasn't moved with other companies in the space. And today, we're in the process of addressing that one final issue that's been holding us back. Okay,
which is a large raise. It's quite a big number, like over $40 million. It's not to be ignored. Your market cap is around what, 29 million bucks, and you're raising 40 million bucks. Why so much money?
Well, we have to be careful. So I'm going to kind of step into the Australian dollar rather than the US dollar. And we'll talk Australian dollars for a little while now. Our debt in Australian dollars is about $27 million. And our capital raise, we're looking at about $40 million on the raise. So the purpose of this raise is to entirely eliminate that debt in the nearest prospect that we can. And then we'll be, taking on some additional funds to carry our company forward with the initiatives of improving the low pH technical understanding, some optimization, some de-risking of our project moving forward. So the scale of the raise is really one that is recapitalizing the company. Going after a rather large raise at this time, the fundamental purpose is extinguishment of the debt. Everything else that we're going to do, could have been done with a much smaller raise, but the debt extinguishment is the main purpose.
Right. Okay. And I do understand that. You've had conversations with the lender. You've extended it a few times over the past few years. They've reached the end of their tether, have they? I mean, I know you kind of got extension from, again, April through to end of June.
Yeah. Look, Matt, we took this debt in 2016 when the company had just stood up the project and was just beginning production. Over the last 4 to 5 years now, we've extended the debt on a number of terms. We've changed the conditions on a number of times. And today we really do believe that, with the debt coming due at the end of October of this year, we really do face a very real prospect that the investment horizon for those lenders and that lender group is really near the end, and we're not certain that we would be able to extend or change the terms and conditions of the debt moving forward. Beyond that, and we pay $3 million a year, Australian, in interest and servicing of that debt. So that's a big chunk of corporate burn that's being financed by our investors. So it's important for us to look for ways to reduce our burn rate, reduce our costs of moving forward, and so extinguishing the debt became a real priority for us.
But why this method? Why a 45.4% discount to the share price, as I think it was at some point in May? That's hugely dilutive, isn't it?
Yeah, well, we recognize the offer price is a significant discount to our last closing price or to the pricing of our last capital raise, which was completed at the beginning of this year. The COVID-19 influenced markets today, and in those markets, equity raises that are primarily for the repayment of debt or for the restructuring of a balance sheet are being similarly priced. This is a substantial discount, but it's in the ballpark and the same pricing as you would see if you looked into the universe of other raises trying to accomplish the same thing. Matt, we priced this rights issue to minimize the execution risk. We think the pricing puts values in the rights for the shareholders so that they might clear the market if any current shareholders did not wish to or were unable to take up their entitlements. These shareholders may be able to realize some value by selling their entitlements in the market because of the way we priced it today.
So who recommends to you that's the price? And what was the starting price? I'm assuming you negotiated it, but it's still 45.4%. So what were they originally recommending?
Well, this was, you were looking at a 50% discount. We weren't quite at that level, but you can see raises of this type in the markets today offering 30 to 60% discounts.
Yeah, well, it's pretty much. I think the retail investors is kind of taking their breath away. They're not quite sure what to make of it, And so, well, you tell me, what do you think they should make of it?
I want the retail investors to be assured that the form of this capital raise was selected because it puts our current shareholders front and center first. They have first rights to take up this well-priced offering. We didn't do a placement to institutions in advance of opening up this rights offer. This rights offer goes to our shareholders first, and if they take up their rights, nobody else will. Now it's fully underwritten, and it's been underwritten by Canaccord and a group of sub-underwriters. So if the shareholders do not exercise their rights or opt not to for one reason or another, we can be assured that this raise will be successful. But very important to the board, very important to the company, was the treatment of our existing shareholders, and that's why we selected this form of a raise. And it is inherent with this type of a raise that there are generally larger discounts. But again, each of our current shareholders has the first chance at these well-priced new shares.
Okay. What were the other options you looked at?
Look, for the last 18 months now, we've been negotiating an arrangement that would achieve a partial monetization of one of our offtake contracts. And the intent of that monetization was to repay the debt. That's been a part of our story. But the viability of that arrangement really depends on the ability to purchase uranium in the spot market and at the time of execution. And the ability to buy at a price that would generate a significant upfront payment to the company. With the recent increase in the spot price of uranium, the upfront value for monetization type of transaction has diminished significantly. So the appeal, the attraction of the monetization is not what it once was. And for us, we're being mindful of the proximity of the maturity of our debt. We did look at all of our realistic options for the company, and we took the prudent decision, we think, to avail the company of what is a fairly certain market right now. The Australian market is a pretty buoyant fundraising environment at the moment, and it's not always like that. It hasn't been under the COVID environment. There's been a lot of uncertainty in the markets, and it may return to a volatile and uncertain market. So we see this as a good time to remove the specter of the long-term debt. We think this was the best mechanism that we could look at. We value our shareholders, and we put them first in line for this raise. And really, other mechanisms that didn't put our shareholders today first in line were quickly eliminated.
You must have been one of the few uranium companies wanting the spot price to stay low then.
Well, that is the irony, Matt, of our position. The monetization depended on a low price, and the markets were low for a long time. But the monetization transaction was just simply not getting done with some of the negotiations and the agreements that had to be completed. We had a structure that we thought was a win for all parties, but there were some contract details that weren't working out. We've looked at it. It's gone on long enough. We needed to reduce, the price of uranium going up was against the interest of the monetization, but Matt, it certainly is not against the interests of the company in the long term.
Right. True. A couple of things on the actual terms. First of all, the date for this is what's the date for this?
Well, the record date, for shareholdings is June 10th, but we're really looking to complete this raise in the month of June.
Right.
We'll have the proceeds and completed by the 30th of June, and we'll be printing a strong balance sheet for the end of our fiscal year for the end of the June quarter.
So a question from an Aussie shareholder: why didn't you do it after the end of the Aussie tax year? Allow them to sell down some of their shares and then roll over the capital gains into next year.
Yeah, I've heard a few folks say that it would have been more advantageous for the current shareholders. First and foremost, that wasn't something that went through my mind. Sitting in the U.S., I don't have the same tax years,
right?
And maybe that was a miss on our part. But our motivation for the timing was to make sure that the company was debt-free and had a strong balance sheet at the end of the fiscal year.
Right. Okay. Second thing, Canaccord. Under what terms are they're underwriting this, but what they're going to have a position in this at the end of it? I mean, how are you paying them?
Well, Canaccord is brokering and underwriting and managing the process. Euros is also a co-manager of the process. Canaccord gets an underwriting fee of 5% and a management fee of 1%. So the total cost on this is about 6% of the proceeds. And Canaccord has gone out and enlisted a book of sub-underwriters. They do that on their own, but we've talked to major shareholders, we've talked to investors and high net worth folks, and interested in this space, and so it's not actually some of the Canaccord folks, some of the principals are in that investment block, but the sub underwriting is being done by institutions and outside of Canaccord. So
Okay.
we're not seeing Canaccord taking a major position.
Okay, I guess my main concern when I see deals like this and groups like that, and I've had it done to me, so it's particularly raw, is where they dump stock into the market after a 4-month hold. The stock gets hammered as a result and sometimes never recovers, certainly companies of a certain stage. So is that a likelihood here, or have you taken precautions, or have you been given assurances?
Yeah, look, that's a concern. Everybody has that concern, and what we wanted Canaccord to do was to get a strong book to strengthen our registry. We've asked them to look for investors who are long on uranium, and they have. We have, very good support from long uranium funds in the sub-underwriting book. We did not want fast money in this deal. Really, what we want is for our existing shareholders to exercise their rights. We want them to benefit from the pricing and the future that this company has to offer. We appreciate our current shareholders' support coming into this, and we hope to continue to enjoy them. We encourage them to all take up their rights. The best way to avoid fast money coming into this company is for the shareholders who are currently owning the company to take up their rights.
No, absolutely. But at the same time, you don't want to hold them to ransom here on needing to do that when some of them, may not be able to, and some may also be long suffering, buying in at much, much higher prices, and you're asking them to kind of double down on something which you need to give them comfort that you believe you're going to be able to get over the line. Not just the raise, but in terms of getting the company into production and survive long enough to be a player in this market.
And that's really, Matt, what the residual of this shareholding is about, and our current cash position. We look to see that this company can move forward with our de-risking and optimization work at Lance and start to prepare for the resumption of production operations at the facility with our current cash flow. We'll have a strong balance sheet that'll carry us through 2021 and beyond, and into 2022, and not just sitting on our thumbs. We're going to be working to advance the technical aspects of the project. We continue to identify ways that we can make this a stronger production operation at a lower cost. We want to continue to test that. We've been preparing a new field demonstration. As you know, we've done one field demonstration at the project already with the low pH, but now we're at the cusp of starting a second field demonstration. We'll do that in July or August, but certainly we'll be starting the new field demonstration in the September quarter. We're going to invest in the project. We're going to invest in getting it ready for production. The reality is, we haven't made a final investment decision to start or resume operations, but the market trends are very positive, and we're prepared to do this. We're prepared to ramp up our production on general market improvements or on U.S. market opportunities. And we believe, and we've looked at this very closely, we can be back in production and producing at a healthy rate within 6 months of a final investment decision.
So you've got this raise. You're going to be able to retire that debt. So you're going to be debt free. So there's no burden. Was that a securitized debt position as well? Sorry, if I may understand. I'm just trying to understand the severity. So it's securitized. So it's quite severe. You can park that up. You do have, if I remember from our last conversation, some revenues over the next couple of years from your contracts that you've got in place. I mean, how much are we talking about as a contribution there?
Sure, right. Well, look, over the next 18 months, our contract book has 525,000 pounds of deliveries. If we do that, if we supply those deliveries from the market and make purchases in the spot market today, our deliveries are priced well above the spot market, so there's a good margin on that. If we did this without producing, we could realize a net inflow to the company of $9 million over the next 18 months. Looking forward into the future, our contract book extends out to 2030. and generally is 400 to 600,000 pounds per year, every year from now to now to 2030. So we're really just moving into the sweet spot. And one of the benefits, if you will, of not conducting the monetization is that we're preserving that strong contract book and the near-term deliveries, which were the ones that had the most value in a monetization. So rather than taking money today through a monetization, but taking less than the value of the contracts, we're preserving those contracts. And in 2021 and 2022 and 2023, we have a stronger contract book and much stronger revenues.
Okay. I'm just trying to get an idea of numbers here. So you've got, over the next 18 months, $9 million of contribution. What's the delta after you've paid down your debt, paid any interest, and paid fees to the various parties? I mean, what sort of number are we sitting on?
Well, the residual, yeah, right. Pardon me while I grab a sheet of paper with some math on it.
Yes.
There we go. So, out of the 40 million, which we're raising, 27.5 is going to go towards the retirement of the debt and the payment of the interest. 6% of it is costs for the equity raise. Generally speaking, we're looking at having $9 to $10 million Australian proceeds available for us to advance the project, to do the low pH transition, de-risking work, and to carry the company forward. We had a good quarter. We're having a good quarter. We had some revenues in the second quarter of this year,
right?
And our balance wasn't significantly diminished because we've been very careful with our spending. So we're coming to the end of this quarter with a good cash position. We'll pick up some additional cash through this equity raise, and we'll be fairly strongly cashed up. The potential to be, I guess, somewhere in the range of 16 to 20 million Australian.
Okay, 16 to 20 million bucks. Your G&A is what for the next 18 months?
Yeah, well, our corporate overhead has been reduced to probably around the range of 2 million per annum,
right,
or less.
Okay, so 3 million. So you got 3 million there for the next 18 months.
We've knocked that down. We're spending money at the project. We're spending money on.
That's what I want to get to. What are you going to do with this money? You've got some cash. Do you just sit and wait it out because the market's doing what it's doing, or are you progressing this new low pH solution that you've come up with?
Absolutely advancing the low pH.
At what pace? At what pace? What are you doing?
We're spending the investment into a field demonstration. It's going to be about 3 patterns of wells. We put these wells in. You spend $250,000, $300,000, $400,000 on well installation, and then you're going to acidify or start running the operation. You have operating costs, chemicals, etc., to run the test. I see that as being $500 to $1 million. These are U.S. dollars because I'm looking at the U.S. operation. So we continue to pour money into the technical improvements. We have some test work, laboratory test work, and other scaled up test work that we'd like to conduct. Each one of these technical evaluations are leading to optimizations. At the end of the day, I think we'll be issuing a new feasibility study on the project, and then there's costs associated with issuing a new technical report for any project. But this isn't just about overhead. This is about investing in the project, not sitting on our thumbs and waiting for the market, but again, bringing our project to a better point so we can enter the market sooner, at a better operating cost.
Right. Okay. So we're moving on to a slightly healthier bit of the conversation, which is how do you get your company into production? Again, I know we've had a talk previously, but for people new to this, your predicted time frame for going from these tests through to feasibility study, through to a point where you're going to understand the economics better, What are you allowing for that time frame?
Putting the company in production and conducting the tests is not mutually exclusive. That can happen concurrently, and that's important to understand. If we decide to make that investment decision because the markets are good and good days are upon us, we can be in production within 6 months. We have 2 existing well fields at the facility that have not been optimally mined that we can today start putting into production as low pH and recovering more or additional uranium from resources from those areas. In the we do need to invest in some of our facilities to make it compatible with the low pH chemistry, the change of chemistry, including acid storage tanks, including refurbishment of our wastewater systems. All of those things, we've said we're ready to start doing some of the initial preparation. As the market signals indicate, we'll be investing in that right away. And we have the resources and the flexibility now to do that with this capital raise. We don't have to wait and say, okay, now the market's good, let's raise some money so we can start. We're actually going to be in the position of saying, now the market's good, let's start.
Okay, so you can be in production in 6 months. At the point you've got all of this stuff in place, is that what you're saying? And you've got the money for that. So when's the next raise?
Well, we have the ability, with this planning to put us into 2022. We're going to have a good cash flow, a good positive cash flow in 2021 with the contract sales that we do expect to have. So we're really not going backwards at this point in time. We have year in, year out sales that can be met. Either through production or from the markets, depending on what the market tells us to do. The market goes up, we'll meet our sales through production. If the market stays low, we'll probably meet our sales through purchases for the period that we can. So we have great flexibility. We're going to have a good cash balance, and we're going to have revenues that really nobody else in our space can speak of right now.
Okay, so you talked about a bunch of stuff there. So can you break it down? How do you spend the spare capital that you're going to have? You've got about 9 million left from the 40 million Aussie raise. You talked about maybe over the next 18 months, 9 million contribution there in terms of, depending on what the spot price is. And how are you going to allocate that money? And at what point do you stop? If the market's not recovered, at what point do you stop and go, okay, we need to sit on a cash reserve here. We've done enough testing. We know how to do this when it gets going, but the market's got to give us those signals.
Yeah, I mean, Matt, you're asking the questions that we ask every day. Is the market right? Should we be investing or should we be waiting? Correct. Today, we know that we can guarantee or feel a lot better about the ramp up of our project if we invest in de-risking and optimization. And we're ready to put several $1 million into the technical de-risking and optimization of the low pH transition. We're prepared to do some of the fundamental investments that some of the longer lead time investments that are going to get us ready for production. So we have now, not allocated, but we now expect to have the resources to do these things, which are going to put us in a prime position to make the investment decision to start production. That decision hasn't been made, and we're going to watch the clock. We're going to watch our cash balance very closely. We're going to be good stewards of the resources that we have. But we're absolutely planning to advance our capabilities and understanding of the project so that when we do come into production, we'll come in strong.
Okay. Do you think the retail market understands what you're trying to do and why?
I hope so. We've been communicating the importance of the low pH transition at Lance for the last 2.5 to 3 years. I mean, this is something that has been front and center in our story. This transition will put our project into a lower operating cost position with a higher productivity from our well fields and our ore body. This is technically a very important thing that we're doing with the transition. We're the first company in the United States to use what is the global leading uranium recovery process, low pH ISR. And our project is particularly amenable to that chemistry. Not everybody in the United States should use that chemistry, and our industry in the United States for the longest time has fully relied on the alkaline chemistry. But this is a case where the technicals tell us the alkaline chemistry wasn't the right thing to do, and we should be, doing the low pH. We've achieved the regulatory approvals that we needed to move forward, and now it's really on us, to invest in the project and start it up when the market says go.
Okay. Do you think your prospectus has done a good enough job of explaining exactly why you're doing this, what you're going to do with the spare capital, and what are you going to do to kind of get the forgiveness of the Aussie retail investors?
I hope so. We put a lot of effort into the prospectus, and I can tell you too that a lot of effort goes into describing the risks of these operations, in the company and general market risks, for any company. So I would encourage the investors to read the prospectus to understand the pathway and the trajectory that this company has been on. The accomplishments of the last several years are really remarkable when you look at it in the hindsight. Today, this is an opportunity for us to recapitalize this company, to put it in a position of strength and having the ability to rapidly respond to the market stimulus. We all hope and expect that the uranium markets are on a positive trajectory, an upwards trajectory. That's what we've been seeing. We think that'll continue. And, our company is preparing itself to respond to better markets rather than the markets that we've seen for the past decade.
Could you have waited longer?
Could we have waited longer to do the capital raise?
Yeah.
I don't think so. And this was really our judgment. The debt wasn't due immediately, but the longer you wait before you try and retire your debt, the bigger price you're going to pay to do so.
Wayne, thank you very much. That's a great update. I know it's been a tough few years, really, isn't it, for uranium? And I guess the early signs are there. I think people are encouraged by what's happened in the last couple of months, but you guys have still got a long ways to go, and you've got to get yourself in a position to be able to fight that fight. So, thanks for today. Stay in touch. Let us know how you're getting on, and if there's any news, pick up the phone.
Thanks, Matt. We're doing everything we can to position this company for the rebound. We believe the rebound is here. We've seen the early signs of it. The uranium pricing in the $34 price range, maybe just the start. There's certainly a lot of macro impetus to see the uranium price go up. We see that happening. We want to be ready. We want to be on the front line, producing uranium early and enjoying the profits of being well prepared.